Okay, welcome to this session on Is Tax Avoidance by Multinationals Over? Reflections on the most significant tax reforms of the last century. My name is Michael Devereux. I'm a professor in the Surrey Business School here. I'm also director of the Centre for Business Taxation, which is one of the research centres within the school. And I'm here to introduce Victoria Perry. So Vicky is currently a professor at Georgetown University in Washington, DC. But actually she's mostly well known for the fact that she worked for the IMF for 28 years in the Fiscal Affairs Department. She left the IMF a couple of years ago, and she spent a year here in Oxford visiting the Centre for Business Taxation. And she's a visiting professor of Oxford University. So Vicky is a lawyer, an expert in taxation. She was Deputy Director of the Fiscal Affairs Department in the IMF, and part of her job there was to visit countries around the world and give them technical advice on taxation, on tax policy in particular. So in the course of that, over nearly 3 decades, she visited more than 50 countries doing
Yes.
that. So she's also written a lot. She's co-authored several books, including a classic book on VAT, the modern VAT, and another classic book on corporation tax, the corporate income tax is under pressure. She's done lots of other things. I won't use up the entire hour by telling you about her, but she is currently Vice President of the International Institute for Public Finance, and she's a past President of the National Tax Association and of the American Tax Policy Institute. So she knows what she's talking about when we come to tax. So we're going to be, the idea here is to think about kind of tax avoidance and multinationals, and what's really happening is that we are actually in the middle of kind of really one of the most exciting reforms to the international tax system in the last 100 years. So it was kind of essentially formed in the 1920s. We are in the process of fundamental reforms to that now, and we're going to talk about that. And there's something called a global minimum tax. But before we do that, I'd like to start by just getting Vicky to actually set some of the context of what the existing tax system looks like, how it works in particular for low-income countries, where Vicky's done a lot of her work. So Vicky, you spent 30 years at the IMF. Tell us about the work that you did there to start off with.
Well, thank you, Mike, and thanks for having me here. As you say, I spent a lot of my time in the last 30 years working with low-income countries or lower-income non-OECD countries, but partly giving the kind of advice you were talking about, where teams will visit countries and give them advice on structuring their tax system, making it better, making it work better for them. We also did a lot of internal advice to our colleagues, our macroeconomic colleagues, who do what you probably may associate the IMF with, which is the lending programs, the surveillance programs. Some of that is quite public. Think about the Greece crisis. And the Fiscal Affairs Department plays a pretty big role in that too. And we also do, as Mike was alluding to, we do a lot of relatively applied analytic research, especially cross-country research, because we're in a sort of good position to look at lots of countries and their data.
Because, how many people work in the Fiscal Affairs Department doing that kind of work, roughly?
Well, roughly probably 80 professionals in taxation,
right.
Almost all of whom are actually economists or actually professional tax administrators, because we have two divisions that do divisions, meaning probably 20 professionals who do tax policy, and a couple of divisions that actually work on improving revenue administration, which is an enormous issue in developing countries. But I dare say, if you're reading the paper, it's an enormous issue here, and it's an enormous issue in the United States as well.
Indeed. Okay, so let's kind of focusing on tax in particularly low-income countries, but more generally, if you like.
Sure.
Are low-income countries doing well in tax? How what are their tax systems like? How are they working?
Well, in a sense, they're like at this point in the world. Perhaps increasingly so over the last 40 years. They're really, on paper, they're quite like the tax systems of the OECD countries. They've got corporate income tax and personal income tax and value-added tax and excise taxes, so the main taxes. But there are two big differences, I think, and we could actually look at this.
Okay.
At some point,
so
we can look at a slide for
we
this.
prepared for this question, actually, so there is a slide. If we could we put a slide up? Okay, you can see it here as well.
Okay, so this is one of the ways that that they're different, which is that even though they have what sort of looks like similar taxes, they raise a lot less money as a proportion of GDP, and that's what this slide is showing. It says basically a proportion of GDP. So the bottom line is low-income countries.
Yeah.
The top line is high-income countries, and the two in the middle are upper and lower middle-income countries. But you can see that there's a really huge difference. The high-income countries raise more than 30% of revenue, of GDP in tax revenue, and the low-income countries have been doing better in the last 15 years or so, but this goes up to 2020. But they're still, on average, not above 15%.
15% a magic number?
Well, it has been said to be a magic number, actually. 15%. There is some work that indicates that countries that raise less than 15% of GDP, roughly, in the public, that is, transfer that money into the public sector, have lower economic growth than there's a sort of tipping point around 15%. This is,
can we actually have the next slide?
Yeah.
I think this is...
And this shows this fact. This shows sub-Saharan Africa. These are all the countries of sub-Saharan Africa, and the black line across the middle is 15% of GDP. This is tax revenue as a percent of GDP in 2019. And you can see that the majority, for sure, don't get above 15, and well over half are below 15. I would just say that the ones on the right, the ones that are above 15, are a bit special circumstances as well.
Okay.
A few of them are raising that money because they're extremely rich in resources,
Right.
like Angola.
Okay.
They're also the higher income countries, like South Africa's over there. And there's some other special circumstances. If you're talking about your sort of random sub-Saharan African country, it's on the left and it's below the line.
Right. And there's
this
clearly
is
quite a lot of them. There's 20-odd countries below 15%.
Yeah, and this is just sub-Saharan Africa. Of course, there are low-income countries elsewhere as well, although a bigger proportion are in Africa these days.
So there's also a difference in, relating to this compared to high-income countries, there's a difference in the structure of which taxes they collect their revenue from.
Yes, there is, and there's another slide that I think shows that, and here it is.
Yeah.
So what this is sort of showing you is, on the left, this is 100% of tax revenue. The bars are each 100% of tax revenue. The left bar is the average for low-income countries, lower middle, upper middle, and high income. And probably the main thing to note for today's topic is that the dark brown.
That's the second one up.
The second one up from the bottom is the corporate income tax. Now remember, this is a proportion of their total tax revenues. It doesn't say anything about absolute numbers.
Yeah.
But you can see that the low-income countries raise a much bigger proportion of their admittedly much smaller tax revenue from the corporate income tax than do the highest income countries. A lot of people, I think, when they're faced with that, find that quite surprising. But you can see probably the principal difference is coming from the fact that the teal-colored bars at the bottom are the individual income tax. And as you can see, there's an enormous difference between high-income economies, which raise a pretty substantial part of their tax revenue, and also of their GDP, from the personal income tax versus low-income countries. And finally, just to sum up, the VAT, or sales taxes, are the red color, and you can see that this is important for the two things that the low-income countries are most relying on are, first off, the VAT, and second off, the corporate income tax. So again, even though they don't raise very much tax, a lot of it's coming from the corporate income tax, so it's very important for them.
So you have one more slide, which is just looking at this is just looking at the corporate income tax.
Yes. And you can see, and it's important that it's non-resource rich countries because the oil and gas and minerals throw that off. But you can see that, again, the red one at the top there is low-income countries, and you can see that a bigger percentage, this just shows it in a different form, a bigger percentage of their total tax revenue is coming from the corporate income tax. So again, these things we're going to talk about multinationals today is very important for low-income countries.
Right, so what it suggests is actually when we're talking about tax avoidance by multinationals, we're really talking about shifting profit, not paying corporation tax. So corporation tax is a tax on profit.
Yes, correct.
Low-income countries depend more on that kind of tax than high-income countries. And so, if there's a problem that actually multinationals manage to avoid that tax, it's likely to hit low-income countries more than high-income countries.
Yes, even though a lot of the squawking in the public press is about the high-income countries. Yeah. In fact, it's a bigger proportionate problem for the low-income countries.
So, big question. And if we look at thanks, we can move on. We've done those, I think. So if we, think about that 15% again.
Yeah.
So this is real saying, it's good for growth if governments can raise 15% of GDP in terms of tax revenue.
Yes.
So what's stopping low-income countries from doing that? Why don't they just raise tax rates and raise some more money?
Well, their tax rates are actually not very low.
Okay.
Their tax rates, their corporate tax rates on paper are actually higher on average than upper, middle, and high-income countries. And for example, sub-Saharan Africa, the statutory tax rates are between 25 and 30% for corporate income tax.
Right.
And their VAT rates are not terribly low either. So it's not really a rate question.
So what is it? What's going wrong?
Let's look at the personal income tax, for example. They raise, as we noted, pretty little revenue from the personal income tax. And a lot of this, but all of these things have to do with the structure of their economies. They have, a lot of low-income countries have a pretty big subsistence economy sector. Very hard to collect taxes from a subsistence economy, hence the word subsistence. Like, people are barely subsisting as it is. If you were, in fact, in a modern world, like we're used to the progressive personal income tax, and at the bottom end, the very bottom end, people don't even pay that because we think they have too little money to do that. Yeah. So you don't really want subsistence farmers to be paying an income tax when they're barely feeding themselves. So that's one thing, it's the structure. There's not much of a middle class in a lot of low-income countries. There's an elite, but there's two problems with that. As the saying goes, you can't balance the budget on the backs of the rich because there aren't enough of them. Yeah. And so that's an issue. And also it's hard to collect from the rich in some cases, partly because a lot of money can be shifted offshore if you're actually rich. So even in a low-income country. So hard to collect the personal income tax. The VAT applies to the formal sector of the economy, and a lot of the economy is not in the formal sector, as we were just saying, as I was just saying. So it's really an economic structure question to a great extent. You could raise the rates, but it wouldn't raise that much more money because the base matters.
So if you can't, so it's a good idea to go after multinationals then, is it? I mean, because you don't want to tax the subsistence people, middle classes aren't there.
Yeah.
Multinationals, that's where the money is.
Yeah, I mean, there's a bit of a trade-off in the minds of countries, certainly, because they do need revenue. Yeah. And you can identify the multinational investors. There aren't very many of them, but they're very sophisticated, so they don't have a problem keeping accounts. Yeah. On the other hand, if you're the country, you very much want them to invest. And therein lies the problem. There's a trade-off in the minds of a lot of, rightly, I guess, in the minds of a lot of governments about, taxing them more and more, the multinational companies that they hope to invest, and trying to incentivize them to invest more. And it's true with any tax system, of course. the more you tax corporate profits.
Okay, but there seems to be two things there then. So one is, so low-income countries and indeed high-income countries might have incentives to try and attract inward investment. That reduces revenues.
Yes, exactly.
But what about multinationals? Actually, so the tax we do want them to pay, they manage to make disappear anyway.
Yes,
What's happening? How do they do it?
Well, a lot of this is done by what the informal word profit shifting, meaning the way the tax system works, the international tax system, and it's important to note for those of you that aren't completely enmeshed in this stuff, that there is no international law of taxation. There's laws that govern cross-border flows of income, and those are all embedded in the domestic laws of the countries.
Right.
There is a certain uniform structure to that, but there's nothing that says there has to be. But the way it's all played out over the last century is that the country where the production's happening, let's think of a multinational investing in some factory in a low-income country. There, it would be deemed that the profits are being generated there.
Yeah.
So that country has like first dibs on taxing those profits. So you'd think, okay, great, then what's the problem? But there are many ways in which the multinational, and it's probably a subsidiary of a big multinational conglomerate, there are many ways it can shift its profits on paper out of the low-income country or the country in question. Can be a high-income country too, and there's a lot of that. But the shifting is basically done by things like saying the way the system works is something called the arm's length method, or you may have heard the phrase transfer pricing or transfer mispricing. What that means is the tax is calculated by looking at transaction by transaction and adding up to a taxable income. But you can reduce the income from a transaction by, if you're the country where the investment took place, the company in that country will say, well, I had to buy all these inputs. I had to buy inputs in order to make this production, and arm's length, like if I were buying them from a third party, arm's length, let's say they were going to cost 50, but lo and behold, I'm going to buy them from a company I'm related to, and they cost 100.
So it's like buying it from yourself because it's
like,
still a multinational.
Yeah, it's like buying it from yourself, and you get a deduction for the amount you paid because it's part of your inputs to your production, just like if you have a little knitting shop on the high street and you buy yarn to sell to people, you deduct the cost of the yarn, and then you just get taxed on the profit.
So if we look at a multinational kind of worldwide, there's a certain amount of profit it makes worldwide.
Right.
But what the tax system is making us do is to say, you're operating in 75 different countries, and we have to work out how much profit you're making in each of those 75 countries. That's going to add up to your global profit. But actually,
theoretically, yes.
Or in principle, at least.
Yes.
But actually, doing that, saying, how much did I make in country A or country B, is pretty hard. It's hard anyway.
Yeah.
And there's an incentive for multinationals to try and make that profit appear in a country with a low tax rate.
Right, and they're very good at that. So that's one way.
Yeah.
Another way is by using tax treaties.
Okay.
There's a huge global network of tax treaties, one country to one, sort of bilateral tax treaties. And the original idea for tax treaties was to split income between two countries so that it wouldn't get taxed in both places. The two countries, in a certain format that's developed over the years, agree, okay, in this situation you get the income, in this situation I get the income, and everybody's happy because we don't tax it twice. Or we split it for the company. In the last 30 years, the number of those treaties has just exploded. Yeah. In fact, in the last 50 years, it's gone from a handful almost up to over 3,000 of those treaties.
These are all kind of bilateral, so
yes, they're all
two
bilateral.
countries. Yeah.
And many of those treaties now are, to return to my low-income country friends, many of them are low-income countries.
Yeah.
non-OECD countries. And those treaties can be used, they weren't supposed to be used for this, but they can be used for shifting taxable profits offshore to the other partner. So one way to do that is, when I'm paying out interest, say, or I'm paying interest to a related company I borrowed it from, generally. Normally, under the domestic laws, there'd be a withholding tax in the country that was paying, where the interest was being paid from. But tax treaties, for example, might typically reduce that withholding tax to zero. So there is no tax being imposed on that flow of money out of this country. And then you'd think, well, okay, that's fine. They decided to split it. The other country will tax it. But the other country is usually a low tax jurisdiction with no tax on that money.
Yeah.
So that's profit shifting. The profit has been, it's another way.
The profit is paid out through a kind of like a payment of interest or dividends before the country might have taxed that as it was paid.
Yes.
And they sign a treaty which says, we're not going to do that. We're
It's
not going to
gone.
tax it anymore.
We're not going to tax it.
Why would they do that?
Well, you might ask. And I think more recently, it's being increasingly recognized that it's a bad idea.
Right.
But they would do it because it's been typically the case that it's supposed to help generate investment.
Okay.
Typically, a multinational company may even say, if it's powerful enough, we'll put this investment here if you have a treaty with X country. And that's why it's another form of incentivizing people to invest.
Right, so this comes back to this trade-off between we want the inward investment.
Yes.
We don't feel we can tax them very much because otherwise that inward investment will go somewhere else, and that's worse.
That's worse.
We'd actually prefer the inward investment, but without getting taxed. Because if it goes somewhere else, we can't tax it anyway.
But if you put the whole thing together and look at all the countries together, what you do, there's a lot of other, that I'm not going to go into, really fancy ways of shifting profits that have to do with like entities that are like, black in one country and gray in another, and so to speak. They characterized in different ways, things like that are very complicated, but there's an entire, more than an army of lawyers and accountants in the world that specialize in doing that. And they're really good at it, and it's all actually legal.
It's legal, it's extremely complicated,
Yes.
and it's hard for tax authorities to keep up. And, I guess you have the tax inspector going into a room like this, and they've got banks of lawyers and PwC. Can I say PwC here? But it's perhaps PwC or one of their rivals.
One of the others, yes.
Would be on the other side, all with kind of great arguments as to why actually all the profit was not in your country at all, it's somewhere else.
And it's really hard for like the US and the UK to address those problems. That's one of the big issues for those of you who are totally enmeshed in the US political arguments. One of President Biden's big promises or desires was to give a lot more money to the IRS because they've been undermanned,
the tax authority.
the tax authority, because they've lost so many.
So as you say, this is. I mean, we've been focusing on low-income countries. This is a problem for all countries.
It's a universal problem.
So do you have any idea how big a problem and how much profit shifting is there from one country to which commonly called tax havens? I know you call them low tax jurisdictions.
Yes, that's what we call them.
That's because you used to be an IMF official, so you couldn't use the word tax haven.
It was rather pejorative.
Okay.
And they were members. They are members.
Right.
And it's hard to define.
Sure.
But anyway, low tax jurisdictions. So there are several estimates. As I say, I'm glad you asked me that. I just happen to have some estimates.
You happen to have a number, I believe.
I happen to have some numbers.
Okay.
In 2019, the IMF estimated that for non-OECD countries, about $200 billion of profits, which is 1.3% of their GDP, was being shifted.
Okay.
And we know they're not being shifted to like another high-tax country. They're being shifted to low-tax countries. And for OECD countries, by comparison, it was about $430 billion, but that's because they're so much bigger, that's under 1% of their GDP. They're so much bigger, there's not very many of them, but they're huge. So,
right.
Put another way, a couple of academics who work on this a lot, using data from the 1970s up through 2019, estimated, I love this number, I'm not sure it's right, but it's a really interesting number. In the 1970s, less than 2% of big multinational enterprises' profits were shifted to, they use the term tax havens.
They use the word tax havens.
They do.
So, right.
And in 2019, using all the same methodology and very careful econometrics and all, they got a number of 37% of multinational profits being shifted into tax havens. So you can see, and that translates at the rates in question into something like 10% of global corporate tax revenue disappearing, basically.
So that's a lot.
It's a lot.
That's nearly 2/5 of the all profit is going off to low tax jurisdictions.
It's a lot.
Yeah.
Even if you think that number's high, it's still a big number.
Yeah.
So this is not a trivial problem, and that, I guess, is what leads us to
Okay.
the current situation.
So we spent quite a long time setting that up. So
Yes.
Okay, what's happening then?
Well-
What is the kind of dam has finally burst, and the high tax countries, the high income countries in particular, said actually we got a problem because all our profits are being shifted abroad. What should we do about it?
And it wasn't because they were worried about the low-income countries.
No.
Suddenly,
We
not
can assume
suddenly,
that,
but over time, the public even, certainly some of the people in governments, realized that they really were losing a lot of corporate tax revenue, and the multinational enterprises really did have very low effective tax rates on their worldwide profits. If you calculate all that in a clear way, some of them were coming in at 3 or 4%. A lot of people say that's too low. It's more like 12 or 15. But these are when statutory tax rates are averaging between 20 and 25%. So clearly they're not paying, quote, and this isn't my term, but it certainly was a term that was everywhere, they're not paying their fair share.
Indeed.
Whatever that may mean, it's in the eye of the beholder. But they were clearly shifting a lot of profits, and governments came to decide that the system that they had set up over all these years, essentially, was now really kind of broken. Partly by my legal colleagues.
Okay, so we have a proposal for called different things, but global minimum tax. It's also called Pillar 2, but it's a global minimum tax. What's the proposal?
Right. Well, so what do you do if you think that globally there's not enough tax and the rates, the effective rates on these big multinationals are too low? Partly it's said like fair share because, think about it. Suppose you're a sort of medium-sized company that only does business in, for example, the UK.
Yeah.
High street or small factory or whatever. You can't shift your profits.
Right.
So your profits are basically, you can try to minimize them in some ways, but you can't shift them off because you aren't doing business anywhere else. So you're going to pay tax on your profits at the UK rate.
25%.
Yeah.
It's just gone up from 19 to 25.
I was going to say 19, but I knew I was behind the times.
It's been 25 for the last 3 months or 2 months.
Oh, okay. So some of this fairness argument comes from that.
Yeah.
You're paying 25, but Amazon's paying 3, so to speak, and it's everywhere. So anyway, the big countries all decided, well, we need to do something about this, and also our public has noticed.
Yeah.
So they've come up with, well, if you think there's not enough tax, then we'll have a minimum tax.
Yeah.
Which is what's called Pillar 2 of this massive tax reform project that's going on, a multilateral project, which is impressive. First it was the OECD countries, then it was the OECD and the other G20 countries. Now it's going on in a forum called the Inclusive Framework, which actually has 144 countries in it now.
Okay, so that's kind of most of the world's countries are
most of the world. Well,
sitting around the table
200,
talking about this. Yeah, sure.
Every
The big
country
ones,
you've probably ever heard of,
right,
pretty much, is involved in this. Although some would say that the steering wheel is still being held by the biggest countries, as it always is. But Still, this is a big breakthrough, all these
Okay.
countries.
And
So what did we do?
What have they agreed?
They have agreed that there's going to be a global minimum tax, but it's not quite as simple as that sounds. You might think, and many people do think, that means all the countries agreed they'd impose 15% as their statutory corporate tax rate.
The rate's 15.
Yeah,
That's
the
minimum
rate is
tax
15, but that
Yeah.
isn't actually what happened.
No.
It's supposed to generate, no matter where you are in the world or what you're investing in, it's supposed to mean that the effective tax on your global profits has to be 15%. It's not even quite as simple as that, but that's the general outline.
Yeah.
And what does that do? What does that mean? Well, if before you were a multinational enterprise, and you were shifting your profits to a, just for the sake of argument, say a zero tax jurisdiction, well, if you do that now, assuming this comes into widespread effect, if you do that now, well, okay, you can still pay zero to whatever the tax haven is, but they're going to look at the countries are going to look at your whole global situation, and they're going to see that you're not actually paying 15%. So you're going to have to pay the difference somewhere else.
Okay, and who's going to collect that tax? So suppose we got a UK multinational with a subsidiary in a tax haven. Let's call it a tax haven.
We'll just call it that here.
Which is paying zero tax.
Yeah.
So, but it's got 100 of profit, but it's paying no tax.
Mm-hmm.
So somebody's going to say, well, you've got to pay 15 on that 100 of profit somewhere.
Right.
Who's going to collect it?
Well, to some extent, that depends upon where the 100 came from. If we assume that we have the UK parent, big UK company, whatever that might be, and then we have a subsidiary in a tax haven, and then there's another subsidiary in, say, an African country that's actually producing something.
Right.
But the profits were all stripped into the tax haven.
Let's take that example.
Okay, so we've got 3 countries involved here. Originally, when they thought this up, it was going to be the UK parent, the UK, because the parent company of the multinational was in the UK, and they were going to collect the difference.
Right, so the UK, and most multinationals have headquarters in large, high-income countries like the UK, the US, Germany, Japan.
Yes, exactly.
So the original proposal was those countries would collect this missing tax.
However, a year and a half ago, roughly, it suddenly came to people's attention, almost out of the blue for us nerdy observers, that this wasn't really very fair to the country that was where the income was being produced. So pretty clearly, the tax haven in the middle had sort of made its bed and chosen its path, and it had a zero tax rate. But what about the country where the production was? Shouldn't they get to tax this? So in fact, the proposal was changed to be that first dibs could go to that country, the one where the production was happening. So suppose we've got this 15% gap there, that zeros, where the taxable profits, the paper profits, are now sitting in the tax haven getting taxed at zero. But there's going to be another 15.
Isn't it the tax haven itself could introduce the tax?
That certainly could.
Okay.
It certainly could.
Right.
And perhaps it will.
So
except that there's not really, if it did, there's not really any very good reason to go to all this trouble and send the profits through there, because the only reason to send the profits is to reduce the tax to zero.
Right. So but that's the whole point, isn't it?
Yes,
really?
That's the whole point.
The whole point is to say, if actually you're not going to pay a zero tax rate in this tax haven anymore, you're going to pay 15%
somewhere.
We're not sure who's going to collect it, but it could be the African country, it could be
the tax haven, could be the UK.
But the incentive to shift that profit is going to at least be diminished. It's not going to disappear.
Yeah, it's not zero because, as we just saw, the UK rate is 25%.
Yeah.
So 15 is still less than 25.
Yeah. Right.
But it's not zero.
Yeah.
So in answer to the question, is tax avoidance over? It's probably not over. I won't believe it's over unless they say, first off, let's kill all the lawyers. But it won't be over. But however, it is going to be, I think, greatly reduced.
Okay, so we've been going on for a while here. I've actually got a question. I've got some questions coming online.
Oh, okay.
And I'm going to invite questions from people in the room as well. And I've also got more questions of my own, so I've got to think more about low-income countries. But actually, in the context of what you just said, there's a question from somebody online who said, is it possible for tax avoidance by multinationals to be over when it's big business for the big four accounting firms? And these four firms would never let it happen. So I think you blamed lawyers, this person is blaming the big four, but there's lots of money in tax avoidance.
I mean, yes, and I don't think, if you have a system that's set up with certain rules and you're actually playing by the rules, no matter how complicated the rules are.
Yeah.
It's like me watching American football. I really have no idea what's going on half the time because the rules are actually really complicated.
Yeah.
But I assume that everyone's playing by them.
Yeah, they have referees.
Yes, and that's kind of what we have here.
Yeah.
So I don't think you can, joking aside, I don't think you can really blame any of the players. You have to change the rules of the game, which is what is trying to be done. It is likely, I think, that other things will come up. There'll be things we haven't thought of in heaven and earth yet. But this is really a big deal, though. This is actually a very big deal, this agreement, assuming that most countries implement it. And again, the countries themselves have to implement it. It's all a question of their own laws.
Okay, so let's assume they implement it for the moment. We'll come back to that maybe.
Right.
So it's a big deal. I mean, it's a massive deal in the sense that we've actually got 140 countries around the world all signing up to do this.
Yeah.
They've signed it in principle. They haven't guaranteed that they're actually going to implement it.
Right, but in principle.
In principle. So it's a good thing. So first of all, is it a good thing for high-income countries like the UK?
Yeah, I think it's a good thing if you believe that.
Yeah, your microphone.
My microphone is tangled
just,
there. I'll just try to leave that alone.
Okay.
It's a good thing if you believe that countries actually need to raise taxes and that they need to provide public services.
Okay.
It's certainly true that you'll find people arguing, perhaps more on my side of the Atlantic than yours, that we have too many taxes, too much tax as it is. We shouldn't do this, that it is going to undermine economic growth and such. But I think we're a long distance from that, to be honest.
In high tax
Even
countries.
in high tax countries.
So what about, if we go back to the example, we've got a UK headquartered multinational doing some kind of real production in an African country, and it's shifting the profits out currently to a tax haven.
Yes.
So now we're saying the incentive to shift that profit is going to be diminished. So that's going to be good for this low-income African country as well.
Yes.
Is it?
Well, it's certainly going to, as we say, set sort of a floor under their loosely speaking, tax competition, which is kind of what this comes to. If what you're trying to do is create incentives for the big company to invest in you instead of, the country down the street, then there's a bit of a competition between you. And if you feel like you can't get them to invest, if you tax them more, this may not be a good thing. I happen to think it probably is a good thing because if it applies to enough of the big countries, then it almost doesn't matter what the low-income country does. That investor is going to pay the 15% somewhere. So if you say, okay, it can be zero, it doesn't do any good because it doesn't do the company any good because it will instead just have to pay the difference somewhere else. So it reduces the incentive for the low-income country to keep reducing its tax base.
Which is what we've seen. So we've seen corporation tax rates falling over time.
Yes.
And so we might have two neighbouring African countries both competing for inward investment from a single multinational, and they compete by reducing their tax rates, by having tax incentives, by kind of reducing their measurement of profit.
Yes.
Now they can't do that.
No, so they can do it, but it won't do any good.
Right, below 15%.
Below 15% effective tax.
So isn't that a problem then? Now, isn't it the case that actually they might get less investment in that country now? Because before they weren't paying any tax. They're going to make a lot of investment into this low-income African country. They didn't pay any tax because all the profit was shifted out to a tax haven. Now they are going to pay 15% tax, and they're going to think twice about whether they invest there or not.
Well, some of the countries fear this very much, actually.
Right.
On the other hand, if everybody does it, it won't put the country at a disadvantage, but it will eliminate the advantages it was trying to achieve. Let's put it that way. There actually has been a little bit of work on the potential effect on foreign direct investment from Pillar 2.
This is kind of inward investment into those
inward
countries.
investment into low-income countries. And in fact, this was the work that Michael Keane did with the UN a couple of years ago.
One of your colleagues from the IMF.
Yes, and who's pretty well known at these things.
He's well known in tax circles.
Yes. Anyway, this work, which was extremely careful, found that, as you might expect, the big losers are the tax havens.
Sure.
They're big losers. Problem over what to do about that, but because some of those countries, Ireland's one thing, but some of them don't really do anything other than this at this point in tourism.
Right.
So, but all that said, the econometric analysis was that, in fact, inward investment into sub-Saharan Africa would probably increase at the margin by about 2.4% of the existing amount.
Despite the fact that tax rates are going to be higher.
Despite that, because even though tax rates will be higher, and they took that into account in thinking, well, there'll be probably a bit less investment overall, but the fact that there'll be a bit less overall is more than, it's overwhelmed by the fact that it won't be being diverted through tax havens. So in fact, they think more will actually go to Africa.
So they get more investment and more revenue.
Yes, that's the argument. And there's some, pretty good, I wouldn't say evidence because it hasn't happened yet.
Yeah, okay.
Some really quite good theoretical evidence using existing data so they can measure it. It remains to be seen, and it will be fodder for papers for the next 2 decades.
We in the Centre for Business Taxation will be working on this for years to come. That's certainly
what
true.
actually will happen after this all gets implemented, which it looks to be going to happen, actually. It looks like it will be.
Indeed.
More or less.
Okay. So I have some more questions, but I'm very happy to pause and invite questions from people in the room or people online. Anybody who'd like to ask a question? I've got a couple here already, but would anybody like to ask anything? We've got one in the back row, and then we'll come to you in the front. Yeah. Hi.
Sorry, this may be a very basic question. The tax haven countries, what is the source of income if the corporate tax is 0%? Like, where do they make their money? Because, like you mentioned, it's mostly tourism and these kind of.
It's for a lot of the small island economies that one may think of in this context, it's a lot of tourism at this point. Agriculture was kind of decimated by the EU a couple of decades ago.
So
my question is how do they make money out of being a tax haven? Like, what is in it for?
They don't generate corporate tax revenue that way. They do generate a small, very high income sector, which has a lot of fees, gets a lot of fees. That's where the money comes from.
Basically just banking then?
Banking. It's essentially banking.
Banking,
broadly speaking, yes.
Because they don't have any headquarters offices, just like registered.
They do have,
just
exactly.
Like so
but there's a bunch of expatriates involved in this, and they're rich, and they spend money in the place. They live there. So it creates a sort of sector, a financial type sector.
And sometimes they might have fees for
they get a lot of
kind
fees.
of license fees for operating there.
A lot of fees.
But nothing like the tax they would be paying elsewhere.
Right. That's the business model.
That's a great question. Can I just follow? I'll come to you in just a second. But when we think of tax havens, we think of there's this kind of sun-kissed islands But
not
people
really
also
fair.
talk about Switzerland and
Yeah.
Ireland and Luxembourg.
Right.
Aren't they tax havens
Yes.
as well, or are they? Or
Oh, they are.
We're not using the word
We don't
tax
use-
haven anyway.
No,
but,
we don't use the word, but yes, it's really kind of unfair, and this is
Yeah.
like a lot of those countries really object, the islands,
Yeah.
that they're being, and in fact, there's a lot going on about this in terms of peer review and
Yeah.
blacklisting by the EU and stuff, and the not worst, but the biggest places to do these planning hubs are actually in Europe. So
And they
it's a
benefit
bit
a-
unfair to blame it on the islands.
And they benefit a lot from the kind of things you're talking about.
Very
there's,
much so.
there's big financial activity in these places, in Luxembourg, say.
Yeah.
Which does very well out of it.
So basically,
Do you want to get the microphone? Yeah.
the US has the FATCA law, whatever, any
Yeah.
American citizen anywhere in the world, the banks have to report their income, all the banking details and all that.
Yeah.
So if the US really wanted, they could use, they sanctioned Russia using the SWIFT system and all that. If they really wanted, they could actually blacklist the tax havens, like kind of make sure that none of the transactions from banks in the tax havens are, like they sanction them so that, basically making the entire model redundant.
Yeah, well, you mentioned FATCA, and in fact, in a sense, that's what FATCA does. Any bank that doesn't satisfy the U.S.'s rules for providing information on its depositors and their income offshore is blacklisted in the sense of having huge tax penalties.
And
But it's also worth noting that this whole global minimum tax thing, the U.S. actually did in a different form in 2017, much to everybody's surprise.
So in a sense, you're saying they don't need to blacklist them because actually they can see that money and they can just tax it anyway.
Yeah, that's what they're hoping.
The US has a provision which says, if you effectively they're already taxing
but
it.
they're taxing global income for individuals, but they're not taxing global income for
And
corporates.
corporates, yeah. Since 2017, they amended the tax system to say we're going to tax they tax worldwide income of US multinationals effectively, but they give a credit for taxes already paid elsewhere.
Yeah. So they, in fact, in 2017, implemented a global minimum tax.
Effectively, they did, yeah.
Effectively.
Okay.
And then
I think
the rest of the world followed along with this.
I think the rest of the world, the US actually went to the rest of the world and said,
Look,
we
we're
think
gonna
you should do
this.
it as well.
Yeah.
And that's a good idea. So does UK do the same thing? Or does it have similar
Sorry,
provisions?
The UK.
Does UK have similar provisions?
Well, the UK is trying to implement this global minimum tax in the way that Vicky has been talking about. So it doesn't do it yet, but it will do quite soon, along with many other countries. The EU has got to.
The EU,
is going to do it, and Japan and many other countries are implementing it now.
Korea's already passed the law to implement it. So another big headquarters
There's
country.
cause for optimism.
Indeed, yeah.
Yes, I think so.
We have another question in the front row. Just wait for the microphone. Yeah. Hi.
Hello. There was something I didn't really understand at the beginning when you said, so if all over the world countries would be to implement the new tax system, you said it would diminish the tax avoidance from most of the countries. But I don't really understand, because the tax system sounds very effective. How could other countries still tax evade if this would be at the global level?
Well, as Mike was saying, it's 15% effective tax rate on global income of a multinational enterprise. And it's only, at this point, just to note, it's only to apply to the biggest ones, for starters at least. So, if your home country, like the UK, has a 25% corporate tax rate, there still leaves you some room to shift money around. 10%, basically, 10% worth.
Difference between 25 and 15.
Yeah, so there's still some incentive to engage in this kind of behavior, but the incentive is much, much lower than it was. So I have a tax planning friend who did this his whole life on the public side, on the private side, and the public side, who always says, from the private side, if the difference is more than 5%, it's worth it. If it's less than 5%, it's not worth all the tax planning. So that's how, basically.
Okay, so there will still be cut like in other countries if they try to...
Sorry, can you just talk into the mic so everybody online can hear as well?
Yeah.
Yeah,
okay,
that's fine.
perfect.
Yeah.
So they would still be cut in other countries if they try to evade it. I understood this thing, but the incentive, I just don't really understand why would still be incentive, because if they offshore the profits, there will be like no benefit from them for them, because they would be cut with higher taxes in other countries. So why still?
Well, if you could move all your profits into a country that had
zero tax,
excuse
for
me,
instance?
zero taxes, those profits would be taxed somewhere at 15%.
Well, under the new proposal, but
Under
not
the new proposal.
not before the new proposal.
Right.
They'd be taxed. They'd be untaxed before.
Yeah. So there's clearly the incentive to avoid the tax is much lower. But if you were to structure something in such a way that you could get all of your tax at 15 instead of 25 or 21 in the U.S. plus state taxes, so really 25 in both the U.S. and the U.K.,
Yeah.
if you structured it right, you would still rather pay 15 than 25. So it's not going to completely eliminate the problem, but it's going to radically reduce the problem, I would say.
Okay, thank you.
Okay. Thanks. Other questions in the room or online? Now's an opportunity.
No more.
Well, wait. I've got.
I think
There's a couple here. So one question was just where can we obtain more information about the global tax reforms?
Wow.
Where's the best place to go? Apart from the Centre for Business Taxation
That's
website.
one good place to start, actually. That's a very good place to start.
And all the documents are on the OECD website.
Yes.
So if you go to the OECD and look for the Committee for Tax,
Committee,
what's it called?
The Committee on Fiscal Affairs, the CFA.
Yeah.
But actually, if you go to the, quote, inclusive framework website of the OECD, which is also in the OECD's servers, it will have all the documents for this stuff.
So all the formal documents are there. There's comments in lots of different places.
They have summaries, too. You don't have to read the whole 200-page.
Which is just as well, because I can assure you reading the whole 200-page report, actually, and there's quite a lot of 200-page reports.
Yeah.
That's quite tough.
It's actually, unless you're already steeped in the topic, it's extremely hard to read those and understand what's going on. But there are
some summaries there
that will sort of tell you, like, what's the point here. And there's endless, as the medievalists would say, angels dancing on the head of a pin discussions about very technical details. But to get the overall picture, I would say check the Center for Business Taxation.
It's a little bit technical. I would go to the OECD summaries first.
I mean,
probably.
you could also check some of the IMF, like the 2022, the spring of 2022 annual fiscal report, Fiscal Monitor, had a chapter that covered some of this, and it was relatively accessible. And there's a couple of other papers on the IMF's website, too, that are somewhat more accessible, I would say.
Okay, thanks. I've got a slightly different angle of a question here. It says, is there a link between tax avoidance and corporate social responsibility of corporations? Do you want to try that one?
Yes, but I guess I should elaborate.
Okay, elaborate a little bit if you wouldn't mind. We've got a couple of minutes.
There's a huge debate, actually, about this whole notion of the corporate social responsibility debate about whether corporations, you've all probably seen this, have a responsibility if they only owe, if this is the tax system we have and they're playing by all the rules, how do you decide what's their corporate social responsibility and what's their responsibility to actually maximize their profits? There are definitely two schools of thought on this, if not more. One being, look, like corporate responsibility, like even if it's not illegal to dump horrible stuff into the ocean, it's still not very responsible, but it's not illegal. So should they do it? Another, and tax avoidance or tax minimization is kind of the same. So again, I think there's a link, at least in the sense that there's certainly a lot of people who would say, yes, the world is structured in this way, but it's not responsible to strip out all these profits and not pay your taxes. And others who would say, look, that's what the rules are.
Okay, so it's kind of interesting because you said earlier, no, the kind of problem is fundamentally about the rules. We designed the rules in such a way that actually makes it too easy to shift these profits to low tax jurisdictions.
Yes.
And so there's a kind of ethical question about whether companies should do it, given that it's quite easy to do.
Yeah.
But actually, a better response in a way is let's fix the tax system.
Right.
Let's make it harder for them to do.
Yeah.
So, with a couple of minutes left, is it fixed? So if we think about the long-term tax system, are we going to have? So is it done now? We've got a global minimum tax. The next 20 years, that's going to be fine. All these problems that we've been worrying about for the last 20 years are fixed. We're done. We'll have to close the Centre for Business Taxation because there's nothing really left to say.
I would say that's not true.
Okay, why not?
Because this is definitely going to put some brakes on the careening toward a system in which we can't tax income at all. That's
Right.
where we were heading,
Yeah.
I would say.
Yeah.
This has put on the brakes. But in the globalized world, the modern economy of everything happening across borders and it being really very hard to say, as one of our colleagues used to say, there's a reason they call these multinationals. They don't really belong to any country.
Yeah.
They're everywhere. That being the case, as somebody else once said, corporations aren't people. Ultimately, people bear all these taxes. We didn't talk about incidence here, but the incidence of the tax, I mean, who's actually paying it underneath, even if they don't see that they're paying it?
Well,
Is it the
made
owners?
worse off because of the tax?
Who's made worse off? Is it the workers? Is it the owners? I mean, who is it? Is it the people buying the products? So there's sort of three possibilities, big ones. And this has been a source of endless delight to generations of corporate tax scholars. But it certainly would appear that whoever's paying it, really, they're people. So a possible evolution of the international tax system over time may be that we'll stop trying to figure out where the corporations are resident and whether it's an arm's length price and whether this entity is actually a corporation in Germany but a partnership in the US and something else yet again in Ireland. We can maybe stop figuring all that out. So I don't think it's like over.
So at the moment, we still have to do all that.
We have to do all that still.
So we could think of even better solutions than this one.
And you can find some of those on the Center for Business Taxation
Indeed.
website.
Yeah, just a bit of an advert there. We had other ideas for how to fix the international tax system other than this one.
But I think, I mean, and the big debate is about one big debate, which comes up in Pillar 1. We've been talking about what's called Pillar 2.
Yeah.
Some of you may wonder, well, what happened to Pillar 1? It's a little bit like working on your second $1 million because you gave up on the first. Pillar 2 looks likely to happen. Pillar 1 may not. But one aspect of Pillar 1 was to, remember I said at the beginning or early on that, we were trying to figure out where the production was actually happening, and that's where the profits were being generated in the current income tax system. But a big question has been, and this is not really about the low-income countries, this is about Europe fighting with the U.S. to a great extent, over where are the profits if you're Google and there's, millions of people clicking on Google, but you're nowhere near the country where they're clicking. should there be a tax there on Google? And so one of the things that's happening in parallel with this minimum tax stuff is to try to think about, do we have the right approach at all in saying, well, all these corporate taxes, these corporate income taxes, they should be occurring where production is, but that's a system that was developed when you could look at the factory and see the production. And now you really can't. And many of the huge inputs into really massive excess profits of multinationals like big pharma, like the pharmaceutical companies, the inputs are intangible. They don't really exist anywhere like a factory. So are we going to change the system so that we can apply the tax more where people are actually using this stuff? I think probably.
I can see, I'm afraid we're going to have to, we can ask you a question afterwards, but I think we've actually run out of time. These are great questions. If you'd like to invite Vicky back to answer those questions another time, we could do that and think about more fundamental reform in the tax system.
Yes.
What this is kind of patching up the existing system in a way by having a minimum tax. It's not really looking at the fundamentals and thinking about doing it in a different way.
Yes.
But thank you all for being here. Thank you, everybody who's online. I hope that was useful. And thank you in particular, Vicky, for your great insights on all of these issues.
Thank you for having me, and thanks for the great questions.
Okay, thank you.